other senior members of the management. Q&A will be held at the end. I would like to invite HBL's President and CEO to share his thoughts on the developments and future strategy of the bank. Thank you.
Thank you, Maruf, and Assalamu alaikum to everyone who's on the call. Just a few introduction points. We did share the financials, and Raymond, who is our financial controller, will go through them subsequent to this conversation from my side. But from my side, I did want to touch on a few key items. I think the last couple of years for the Pakistan's economy have been fairly challenging, and we do now see signs of relative stability coming in. And the performance that the bank has achieved, I think, is admirable given the circumstances and the results that have been achieved. Regardless of how things are for us, three things are very critical. One is to essentially help move Pakistan's economy forward. And the second is really around the international network and being able to effectively leverage HBL's international network to contribute to Pakistan's economy, as well as to the economies of the countries that we operate in. And then the third is around the sustainability and the financial inclusion aspects. I think what has been exceptionally exciting and pleasing is the focus that we have had in 2024 around the real economy. And by that, I mean the agri sector and the ancillary SMEs that are associated with the agri sector. Traditionally, HBL has been, with amongst the banks, commercial banks, the number one in terms of this support. We, over a decade ago, we were one of the founding members for the Pakistan Agricultural Coalition as well. And last year, we were successful in creating a new concept, which is Zarai Services, HBL Zarai Services Limited. And this concept in agri is really around the local data and essentially bringing all the services in one location, which is seed, fertilizer, agronomist support, mechanized equipment, and connecting small growers with the buyer side, who are also, coincidentally, many of them are also HBL customers. And to create that eco chain where productivity improvements of 30 to 40% can be achieved, you have a better financial pricing for the farmer, and net results in greater return to the farmer, combined with the less financial cost, as well as the better quality seeds, inputs, as well as the mechanized equipment, as well as the technical support in terms of how to grow crops better, or how to do dairy better, or how to do livestock better. And this is something that really for Pakistan is about 25% of its economy. And if you lay on downstream industries to it, then it essentially becomes a 40-45% of Pakistan's GDP chunk. So with this innovation, now we see, because of the thought leadership of many others and HBL, we have now the entire industry focus on how do we take this forward. Because ultimately for Pakistan's economy, we do need to move from GDP growth, which is import-led, to an export-led GDP growth by value-added crops, while ensuring food security as well for Pakistan. In addition to that, the SMEs that are engaged in this business is where, again, we are the number one leader there, but we have continued services to SMEs to really extend upon, beyond really, like a 5-kilometer radius to really about 20, 30, 40 square kilometers. And then for cash collections and others, it's really nationwide and global. So I think there are exciting times. The retail bank, continues to do very, very well as the consumer bank. Corporate and investment bank continues to maintain the positioning that we have. So with that, I would turn it over to Raymond to give a sense of more the hardcore numbers, realizing that this is really an investor presentation, versus a pitch for priorities or the house. So Raymond, if you want to just take the participants through the presentation, please.
So good afternoon, good morning, good evening, ladies and gentlemen, depending on which part you're dialing in from. And welcome to HBL's annual 2024 results earnings call. I'd like to again thank Farhan and Habib for being our hosts today. As always, I'll start off with a quick run through the presentation, and then we'll leave time for everybody to ask questions. So if we go to the first slide, I think this is picking up from where Nasser left off. In terms of our number one strategic priority is to contribute to Pakistan's economic growth and development. So in terms of expanding our reach, we continue to have the largest number of touch points, whether it's on branches, on ATMs, or connect agents, or through our POS network, which now extends to over 250 cities and towns across Pakistan. Similarly, while we're not number one in terms of the number of IPG merchants, we are almost double the next competitor in terms of the volumes transacted on our internet portals. In terms of trade, our exports have done extremely well, with market share rising to 13%. Imports in a difficult environment have rebounded again with a double-digit market share. Nasser talked about agriculture being a priority, not just for us, but now even for several other banks. As a group, HBL has over 100 billion out to agriculture, whether it's agri, dairy, livestock, and with HBL itself being at 60 billion, we have a market share of 1/3. So that puts us comfortably ahead, almost double of the next competitor in agri. Similarly, we have a market-leading share in SME, which really is the lifeline of this economy, and we aim to do much more in this segment. Our consumer lending remains our flagship business with 142 billion, the steady growth now over well over a decade of very, very robust growth. With personal loans, credit cards, auto loans, all market-leading positions, and in mortgages, now a serious push to get to the market-leading position there as well. If we move to the next slide. Yeah, next slide, sorry. Yeah. So in terms of our digital throughput is up more than 40% year on year to 27 trillion. Pretty much more than half of it is led by our transaction and employee banking business, i.e. cash management. If we look at the top right box, digital throughput there is up 37%, with 73% of transactions now processed through digital means. In terms of mobile and internet banking, we continue to increase ticket sizes, which are up 27%, processing over 7 trillion in volumes during this year. In terms of Connect, we continue to drive growth through our core business, whereas if we look at cards, we have the lion's share of the market, whether it's debit cards, credit cards, or POS terminals. If we go to the next slide, please. So if we look at our balance sheet, our trajectory has gone up, continues to go up both in loans and in deposits. As we all know, deposits during the fourth quarter were not a priority for most of the sector. Advances grew very, very strongly. Advances were up 31% in line with the industry, primarily coming from domestic, but also with healthy growth in our international in both lending and deposits. Investments remained flattish as the growth was skewed towards advances. Our average domestic deposits were actually up 20%, with most of this coming from current accounts. And that's why we were able to contain our cost of deposits to much less than what the CIBOR was. Okay, next slide, please. Yeah. From the next slide. I think it's taking a little bit of longer to load. Yeah. Okay, just one back, please. One slide back. Yeah. No, one slide back.
No, back.
Slide, yeah. So if we look at our 24 financials, the 24 profit before tax is up 6% to 120 billion. The core domestic business is a little bit lower than last year because last year it's some one-offs, and this year, of course, the provisioning has been higher than it was last year. In terms of our international franchise, after repositioning over the last several years, internationals had a bumper year this year with core business in international turning in $37 million in profit. NII, as one would expect, has remained somewhat flattish year on year because of now the falling interest rates and repricing and the delay in the reduction in policy rates. So there was a period of during the year, as you all know, when the policy rate was actually much higher than the PKRV. So our repricing of treasury assets was lower than what we paid on deposits. Our fees are up 13% to 38 billion. As always, cards continues to have more than 50% of the fee base and the fee growth, but we've had very strong contributions from our banking business as well as from bank assurance. So overall, total revenues grew by 11% to 288 billion. Expenses are up 15%, which, if we look at the results declared so far, is actually the lowest growth in the industry. Provisions are up 12.6 billion year on year, primarily due to some subjective provisioning, some general provisions, as well as some problem credits which are common across the industry. If we go to the next slide, yeah. So, again, the composition remains fairly stable with corporate, 44% corporate and commercial, nearly half of the loan book. International is about 16% of total advances. And if we break that up, of course, it's primarily in the three major markets of UAE, Bahrain, and UK. The infection ratio has shown a sharp improvement and is at an all-time low, while the specific coverage is flat at nearly 90%, despite the rise in NPLs in the domestic business. Next, please. So the ADR, of course, has gone up strongly to over 54 in the domestic business. Our CAR has really taken a boost this year with Tier 1 CAR at 14.3% and total CAR at 17.7%. Margins have come off, as one would expect in the falling rate environment after peaking in Q2, because the rate started getting cut from June. The cost to income ratio is coming down, but slowly. That is an area that we need to work on. We are working on it. And as you see from the growth numbers, the cost growth is actually the lowest in the industry. The returns are 16 to 17% range, so still okay, with a book value now of about $1 per share. With that, we come to the end of the formal presentation. We'll now open the floor to questions.
Thank you, Raymond. Can you unshare the screen? Now we'll open the call for Q&A. So once again, for the start, I just want to let all the participants that if you want to ask a question, you can use the raise hand button, or if you want, you can type your questions in the chat box. Kindly introduce yourselves because we are not going to entertain any anonymous questions. Our first question comes from Divya Base. I will unmute. Can you unmute her? Unmute.
Can you hear me?
Yeah.
Yes, we can.
Sorry, I was just going to ask, with the targets to conversion to a fully Islamic bank within Pakistan, how do you foresee this happening for HBL?
So we already have 1/3 of our network is Islamic, and that's something that we will work on under the guidance of the State Bank. We have a full range of Islamic products, both on the consumer and the corporate side, and our Islamic business has actually done very well this year.
Thank you.
Unmute.
Hi, this is Reza, Head of Equities, Intermarket Securities. Congratulations on a strong set of results for 24. There's a couple of questions. So obviously, I think one of the slides mentioned that throughput is now 90%. Is that leading to? I also see, if you go through your accounts, that branches have reduced in 24, right? Is that something that, given that digital is now taking over, do you think that there is less need for branches? I mean, do you think there's a correlation there, and therefore you could see more branch closures? Is there something, any thoughts around that would be great. And my second question is, your CAR is now approaching 18%, and this is with ADR obviously being pushed up to 55%. What would CAR be looking like if ADR was more, say, normal, if there wasn't that year-end push by the sector? So that would be great to know.
Okay, so in terms of the branches, yes, you have seen a slight reduction in branches. I think there's a reduction of about 20 or so branches that have come off compared to last year. It's not that branches are not needed. I think in the Pakistan market, branches will always be needed. But we are using our branch network to target more complex transactions, to target higher tier customers, whereas a lot of the small ticket, simple transactions can easily be done through digital. And so what you see there in terms of 90% of customer-initiated transactions going digital, the idea is also to bring in operating efficiencies, right? Because HBL Mobile, and I mean, I'm saying from experience because I use a number of different applications, is probably one of the best mobile applications around in terms of all the things you can do through it. And therefore, the push here in terms of digitizing is to manage our continuously growing volumes through the same size of branch network by reducing the load on the branches for routine, simple, low-value transactions. So that's the first answer. Now, in terms of the CAR, the CAR would have probably been a little bit higher had we not had this ADR lending. Obviously, it remains impacted by the advances volume, but in our case, I think everybody knows that one of the big ticket items we had was government guaranteed and it's zero risk rated. So our CAR would have been higher, but slightly so.
Understood. Thank you so much. Thank you.
Next question is from Sohail Tai. Sohail, you can go ahead and ask your question.
Good afternoon. Raymond, just a couple of questions. One, when we look at the classification of advances, just in the fourth quarter alone, there was a jump of about 22 billion in underperforming overseas advances. Now, I don't know if this is related, but we saw a jump also in your general provisioning in the fourth quarter after seeing a decline in the first 3 quarters. Could you comment a little bit about what happened in the fourth quarter and how this might affect the provision number going forward?
Well, I think in the fourth quarter, what you are seeing in terms of the general provisioning, as I mentioned earlier on, we are building up some general provisions. So that is definitely something because conditions are still stressed. The economy remains under pressure. We are in an IMF program, and therefore we prefer to be conservative and maintain a certain level of general provisions, which, now that we have clarity on that, we are able to maintain.
And the underperforming overseas advances, I think the number was 37 billion as of September, and it increased to about 60 billion in the full year. Anything of concern?
No, nothing of concern there. Our overseas book is actually performing very well, and the provisioning we've taken on the overseas book has been very limited compared to prior years.
And the other income, the 14 billion number from the closure of branches. Sorry, go on.
1 second. Yeah, I'm asking our CRO to comment on this.
Some of the inquiries related to provisions. So as we have covered in the last 2 or 3 analyst meetings, there are headwinds that there were concerns specific to auto sector, steel sector, and construction sector. With the declining interest rates and the deleveraging that we had seen in the last couple of years, generally most of the obligors have performed well. The concerns that we have forward-looking, where we see a deterioration in the risk ratings based on lower profitabilities, that obviously due to IFRS will have an impact. And we have taken a proactive forward-looking approach. Having said that, the actual number of delinquencies over the last 12 months across the corporate sector have remained subdued. 2 things have happened. Number 1, the working capital cycles across the sectors have been well managed. And number 2, the deleveraging across the balance sheets has across most of the industries had taken place before the interest rate hikes had taken place. So on specific provisions, I would be, I think less concerned going forward.
Correct.
But as far as provisions are concerned, we will continue to remain conservative.
Thank you so much. And coming to this other income number of 14 billion due to branch closures, is this linked to your closure of the local branches or the repatriation of profit from Oman?
I wish we could generate 14 billion.
I wish so too. I wish so too.
But I don't think so. No, this primarily relates to 2 things. One is the sale of our business in Mauritius, and the second is the closure of Oman, which we invested in about probably 6 decades ago, and therefore the accumulation of all the exchange translation gains on that has filtered through into our earnings.
And you've started this process for another jurisdiction. I think Belgium is the latest one. Can we expect similar numbers from other overseas operations?
No.
Thank you so much.
Those are because Belgium, for example, yes, is a very small location. Oman was a large country with a lot of capital, 8 branches at one point in time.
Thank you.
Thank you, Sohail. Next question is from Nihal Qasim. Nihal, you can ask your question.
Am I audible?
Yeah, you
Yes.
are.
Okay. So my question is of strategic nature, and I'd like to direct it to Mr. Nasser Salim. I'm fully supportive of the bank's strategy of supporting the Pakistan economy. I think it's a great initiative. But it seems to me that we're the only ones who are doing that. And given what we're doing, we should be having a lot of leverage in policy. Are we doing anything that the entire banking sector shares into this cost? Because if I look at it from a financial point of view, we were the largest bank. Now we're down to the fourth largest bank. And a lot of this cost that we're doing to support the Pakistan economy is showing in our cost to income ratio. So we're getting market share, but there's a cost to it. And that's making us slip down the rankings. So is there a way is there anything we're doing for this burden to be shared across the sector? Nasir, I think you're mute.
Yes. Nihal, hi, and I think thank you for that question. The key is we are doing a lot more now together, where the Pakistan, under the umbrella of the Pakistan Banks Association, all the partner banks are part of this now. And on the agri side, the reality is, despite everything that HBL has done and despite what the rest of the banks have done, the penetration of the organized sector into agri is less than 10%. The second is balancing what you want as longer term gains versus short term gains. So, I mean, agri is not a charity or a subsidy or whatever. This is a vital part of the economy, and it's a profitable part of the economy. So I think there is now interest, to your question, around alliances and partnerships. So collaborating with the PBA, collaborating with State Bank and the government, we've put together, 47 items that were roadblocks to, effective growth of agri, formal sector. And the majority of those were accepted, and whatever changes State Bank had to do, were done. There were some things we asked from the government. So I think we have to look at this as a business opportunity. And this is what HBL's role has been, to open the door of various sectors which are underserved, and then be able to, based on the economic merits of it, ensure that, we create a better environment for all participants. Because frankly, and I will not comment on any other bank's financial performance, but we do need to balance between organizations. We do need to have different objectives. So our objectives are, we are here to stay, and if we're here to stay, Pakistan's economy is critical. And how we partner, to your point, and take those points across, I think is important. And that is what I see, particularly towards the end of last year and this year. A lot of that collaboration is taking place amongst the banks, with the government, with the State Bank, in terms of comprehensive schemes to make this much, much more better. And that will eventually reflect as sustainable returns in the profitability of the institutions and the sector as well.
Thank you for that. That's very comforting.
And
My
just
next
to, and Nihal, just to give you a perspective, since privatization in 2004, the dividends that we paid out in 2024 are the highest ever. So I think when you look at the trajectory, we are actually going in the right direction on specifically what you had asked for.
Thank you. My next question related to that, what you just said, agriculture tax has now started to come in, has been implemented as of January 1st. And we know that in Pakistan, it may not have an impact in the first 1 or 2 years, but then the FBR will figure out a way. And if you're going to look at it over a 3 to 5 year trajectory, and we see that we assume that some sort of agriculture tax or documentation starts to come in, would HBL be the largest beneficiary, or how would we position ourselves to be the largest beneficiary, given that we made so many investments to create access for both ways, for us to the client and the client to us?
Absolutely. I think the tax piece is important, to have a level playing field. So, when I look at the retail sector and I look at the large established organization in the retail sectors, actually, I'm in Islamabad today. There was a conference, which was collaborative with the government and participants. And the key thing is that, automatically, the organized sector gets put at a disadvantage, vis-a-vis the unorganized sector. And, it's about 60% or 50-50 roughly between organized and unorganized. So if you're paying the tax and the person next door is not paying the tax or is dealing in smuggled goods, so I think there is a greater sense of urgency that is required. I think the government is doing some of the requisite structural reforms, but the faster they are done, the better off we will be, because until and unless there is a level playing field, until and unless the new entrants into the tax field feel that this is a process which will be simple, which will be relatively economical versus, the cost of evasion, and look back is not going to impact them. Because let's be frank, I mean, some of these people have been in business for 20 years, for second generation. So if I declare myself and come in, what happens if somebody opens up the last 20 years record, right? So I think we do need a more comprehensive look on this. We also need to look at, and I think Raza Jafri asked the question around branches versus digital. And I think the key is for us to literally have a war on cash and try and minimize cash, eliminate cash to the extent possible, so that, we do have documented flows, we do have documented trails. And then, the taxation also becomes easy, and the rate of tax for everybody also normalizes, because now it's equitably spread across. So I agree with you. As the provincial governments now have passed the reform, and I agree with you, the proof of the pudding is in the eating. So we still have to see what is the adaptation, how much is the uptake of it, and is that going to create a level playing field or not? Otherwise, we'll have the same challenge in agri as we've got over here. So I think those are, I would say, work in progress items that you're spot on, that we will continue to sort of dialogue, not just for agri, but also the entire taxation structure, for the participants or players in the economy.
Thank you, and congratulations to all of management on the cost control fronts.
And on a personal note, look forward to catching up with you soon, Nihal.
Inshallah.
Thank you. Thank you.
Thank you, Nihal. We don't have any further questions on live questions, but we have questions in the chat box. Okay, we have one.
There is Diva is still there, and Yusra has also raised her hand.
Yeah. So there is Yusra is there. So Yusra, you can ask your question.
Hi, good afternoon. Thank you for the elaborate presentation. So my question is related to the balance sheet growth for 2025. So I understand that, there was some year-end chasing of advances, and there's also been some shedding of high-cost deposits during the end of the year. So just wanted to get a sense of what you're looking at for growth for deposits for next year, and where can we expect current accounts and saving accounts as a percentage of the total deposits to fall, and the overall balance sheet growth in general for 2025.
So look, in terms of deposits, given the low base that we will be comparing to, then probably 17 to 18% growth in deposits. We are also targeting to get our current accounts up because we know that that is an area where we need work. So we would like to hit the high 30s from where we are currently in the mid 30s. That's the ambition. So that then we can be over the 40% mark like some of our peers. Our target is certainly not the high 30s. Our target is the mid to high 40s, but it will take 2 or 3 years before we actually get to that level. In terms of advances, again, if you sort of normalize the commodity lending out of it, then we should probably be at mid double digits growth in advances, about 12% or so, depending on how hopefully with the economy shaping up, the way it is. With the IMF program remaining on track, which will then lead to more macroeconomic stability, we should be able to deliver 12-13% growth in our normal advances portfolio. So I hope that answers your question.
It does. Thank you. And my final question is basically on NII guidance for 2025. I understand there are a lot of moving parts. And with interest rates standing at where they are right now, can we expect NII to maybe come off, perhaps a little more than other banks who have large unrealized surplus on their balance sheets?
No, I don't. Well, several banks with large unrealized surpluses have realized some of those surpluses. But in terms of NII, I think we will see some dip, but our growth in volume and particularly our targeted growth in current accounts should help us to offset some of the margin compression.
Perfect. Thank you so much for your time. Thank you.
Thank you, Yusra. We don't have any further questions on the live side, but we have questions in the chat. So first question in the chat box is from Waleed Rathore, Maple Leaf Capital. What are your expectations for deposit advances for CY25? Where do you expect ADR to stand next year, meaning CY25?
I think I just answered that on both deposits and advances. We probably have an ADR somewhere in the mid to high 40s, hopefully, 45-46%. So that's what we would expect to have under normal circumstances.
Okay. There's this question from Mohammed Tahir Sherman. Main sectors where NPLs were higher. I know the CRO had touched a little bit about those, but Raymond, if you would feel like adding anything on that.
Construction, steel, energy sector.
Okay. Then we have a couple of questions from Hadika regarding advances. Which sectors were these advances coming from? And do you anticipate a reversal in 1Q CY25?
Well, I think it's we had a very large lending to the commodity sector, which has normalized in Q1.
Okay. Then there's a question on the policy rate, outlook on the policy rate. This is for Risha, and on the FX, which the president also sort of touched about. We are noticing pressures picking up on the FX and external fronts, along with rise in inflation. What are your projections for the year end? So this is again for Risha in terms of relating to the policy rate and the concerns that are emerging in the short term.
Yeah, so the way things are going, we feel there's still some room for some cuts going forward, but those cuts look like they're going to be measured. If you've read the MPC statements, they've been very cautious and pointing towards the stickiness of core inflation, which is trending around 8.5–9%. We feel they want to maintain 2.5 or roughly 250 basis point spread over that in terms of the policy rate. So given that, it doesn't seem that we're going to see single digits. So I would think the terminal rate ends at 10.5 to 11%. And then obviously beyond that is data driven. And of course, one other thing that will inform the MPC will be the exchange rate, which, as you pointed out, with increased imports is adding some pressure on the exchange rate. So they'll want to be mindful of that and make sure that we have a smooth glide path on the exchange rate rather than some jerky movements. So all in all, that's what we feel. Low double digits, and then perhaps the MPC is looking for stability beyond that in terms of the policy rate.
Thank you,
And
Rishabh.
if I may add, I think what if we step back and look at it, what we do need to as a country sort of avoid is this boom and bust cycle that we typically get into. So until and unless there is, fundamental underpinnings that balance things out, I don't think there's going to be unbridled growth allowed. The dynamics will not suit it, because then it brings you back to that boom bust cycle. So I think how we come out of this has to be much more, to your point, a smoother trajectory where there is some of those missing pieces that we're focusing on, which is the exports coming up, which is the FX flows getting better. So those input outputs need to be much better balanced, and that is going to mean smoothing out how the pent up demand actually translates into consumption.
Thank you, Nasir Saab. We have a question, a live question from Abdul Rahman Siddiqui. You can go ahead and ask your question.
Assalamu alaikum everyone, and thank you for taking my question. My question with regards to your investments book, given that the major adjustment has already been done in the policy rate so far, given that 1,000 basis points have come off by 1,000 basis points. Now, how do you see the investments book shaping up? Would you like to move more towards fixed investments, or it would still be a cautious kind of approach and see how the interest rates work out and then maybe take a position? Or you think you would like to add more of fixed rate PIBs at this point in time and then maybe realize gains towards the later half of the year?
The environment is constantly changing, and so we're constantly looking at the investment book and readjusting. So it's not a question of let's wait for this or that. I think right now the fixed component is around 30% of the investment book. Perhaps it'll go up slightly depending on the shape of the yield curve. So opportunistically and selectively, we look to add duration, but not where it's going to add a lot more risk to the book. So we've had a downward sloping yield curve for the past year and a half or so, and it's starting to normalize, starting to be upward sloping. And once that transition is completed, then yes, it would make a lot more sense to add duration, but not in a flat or declining yield curve. Then that just really impacts your NII. So we're comfortable with the current shape, and obviously, as I said, it'll be data dependent and opportunistic going forward.
Very well. Thank you. Thank you for your response.
Thank you, Abdul Rahman. We have a follow-up question from Yusra Farhan. Yusra, you may ask your question.
Yusra, you're on mute.
You can.
She's on mute.
Yusra, you're on mute.
Maybe she just didn't.
Maybe I think she forgot. Anyways, there's some questions on the chat box. There were a couple of questions from Sunny Kumar which are already addressed. There's one question from Mohammed Abrar from Habib Limited. He's asking about operating expenses, 13% quarter-on-quarter growth. Can you shed some light on this rise in the fourth quarter?
I think you should look at the operating expenses growth overall, which has been very well contained at 15%. One big number in here in the 13% quarter-on-quarter growth is a number that we've taken as an expense for staff cost, because under IFRS 9, all staff loans, there is absolutely zero P&L impact because there is an offsetting amount in revenue. But the revenue, so if you look at it in isolation quarter on quarter, yes, it's 13%. But that's again, it's a function of timing, it's a function of phasing. I think overall, if you look at our cost growth of 15%, it's well below what even some of the industry stalwarts have come up with in terms of expense control. People are in the 20s and the 30s in terms of expense growth. Our overall expense growth for the year remains very well contained.
Thank you, Raymond. We have another question from Jeffrey Bart from Euphrates New Frontiers. He's asking, can you discuss how your technology investments have impacted your ability to gauge credit risk on the retail side, card side? Are you better able to spot deteriorating credit conditions on the card side of the business because of your technology investments? And if so, do you expect that to lead to better credit quality over the next several years?
So over the last couple of years, as part of the enterprise risk management framework initiative, there are internal model risk units which have been created, and the whole idea is to move away from subjective risk rating of the consumer and the retail portfolio and going more towards predictive models. Apart from that, we are also now building on top of our models forward-looking outlook on our loss norms based on the macroeconomic indicators, and that's also been tested now. So yeah, I think the predictability of the portfolio performance is going to be much better as we move forward.
Card loss norms are much lower than
the world.
I think
If I may just add, Tariq, on this, on the retail side specifically, those are things, as Tariq said, are already underway. But the other elements, I think, which will come in is some of the things that we are now looking at, which is, the real-time, fraud loss mitigation and the use of AI, and looking at, various indicators where we are able to, for example, in supply chain financing and others, really be able to pinpoint, say, for example, troubled regions, troubled group of, entities, so on and so forth. Because as more and more, as Tariq says, decisioning goes to digital, that means that can also be instant approvals. And there, I think the modeling is, once things are through the door and booked, it will also help with the front-end scoring models to ensure that we don't get the right, we do get only the right customers in. But then monitoring that portfolio is also going to, change rapidly. And from a technology perspective, those are continuous investments that we traditionally have in the past looked at, and we'll continue to look at also the forward-looking technologies on those counts as well.
We don't have any further questions. Raymond, I had one question with regards to your international business. Obviously, this is something we've discussed over the past decade, and I think it's heartening to see the international operations showing very strong profitability. Just a thought in terms of as you continue to consolidate operations and improve efficiencies there. I mean, how should we look at the outlook on the international business in the medium term?
Okay, so in the immediate term, interest rates are coming off both in the US and in the UK, right? US interest rates coming off means the whole Gulf is pegged to SOFR, so that will also be impacted there. So there will be some short-term impact, but here are all the positives. The main thing is our footprint is now almost ready to be where we wanted it to be. So a lot of the rationalization we've done over the last 3 or 4 years, we've got rid of the low-performing locations. In terms of our network connectivity, we now continue to grow. We now have almost 400 customers with whom we do business in more than one location. That number 3 years ago was probably maybe 20, right? Because that is now a key pillar of our strategy, is to take a customer with whom we do business in Pakistan and then do business with them in the UK or the UAE or wherever else they're going. Classic example being a lot of agri customers with whom we've done business in Singapore and in Pakistan. Similarly, China, as we put it as our second home, a lot of our relationships are based out of our presence in China, and therefore enables us to do business with those Chinese corporates in Pakistan, in the Gulf, in Singapore, and elsewhere in the region. Because remember, we are the only bank to be in that country and in China as far as Bangladesh, Sri Lanka, Maldives, Bahrain are concerned. We're the only common bank. And that again gives us a very strong leverage. So I think international, in the medium term, you'll see some flattening because of interest rates coming off. But overall, it's very well positioned from an efficiency perspective, from a growth perspective, to now actually start delivering what it should be delivering in terms of absolute numbers and in terms of returns.
Thank you, Raymond. So since we don't have any further questions and we are almost close to an hour mark from the start time, I think we can conclude. Nasir Saab, Raymond, any final thoughts before we conclude this?
No, I would like to thank everybody on the call, and I think what we've achieved is one, because of our customers, and secondly, because of the support of our shareholders and our investors. So we are grateful to everyone on the call for their continued interest and support.
Thank you, everybody.
Thank you. Thank you.
Bye-bye.
Bye.